Welcome everybody to the 40 Finance channel. My name's Jeff Beers. Today I'm going to look at the most popular index fund in the market, which is the SPDR. It's an S&P 500 index fund. And I'm going to make the argument that while you see billions of dollars poured into this fund every year, and it's a staple of American investing across the board, and we'll see why personally I don't believe it's the best default option for investing for newbies or folks who just sort of want to set it and forget it. I think there's a couple other better plays out there which we'll get into. And just a reminder, of course, that these videos are for entertainment purposes only. Please discuss all investing ideas with your financial professional before taking on any risk. But if you do enjoy stock market analysis, investing ideas, and personal finance videos, then please subscribe to the 40 Finance channel. I appreciate everybody's support so far. All right, first, just so everybody understands what we are talking about when we say the SPY. SPY is the ticker symbol for the SPDR ETF that tracks the S&P 500. So basically, this particular ETF tries to mimic the performance of the S&P 500 as a whole. As you can see from this short description here, we're directly from the website. The S&P 500 index is a diversified large cap U.S. index that holds companies across all 11 sectors of the stock market. This ETF was actually the first ETF ever. It launched in January 1993. And it is still going very strong today. And it is a popular pick, as I mentioned in the intro. It's a very popular pick for investment advisors, bloggers, people like me to come out and say, hey, if you don't know anything about investing, just pick up the SPY. Invest in the SPY and walk away, or invest in some sort of world index fund that tracks all of the stock markets. The concept being the safety and diversification, right? With the SPY, you're getting access to all S&P 500 stocks. And so while there is risk in there, that out of 500 stocks, there will be poor performers, you typically can balance out that risk with the wins or the gains of the top, call it 10%. In fact, typically the top 10 or 15% of any index fund carries most of the fund, and then the laggards draw down from those wins. All right, digging a little deeper into the SPY, I found this article on Investor Place, which calls out a couple of really important things to understand about the benefits of using the SPY as an investment strategy. And the writer Todd Schreiber goes on to say, he makes 4 points I'll just call out very quickly. It's home to almost $281 billion in assets. The S&P 500 ETF is still the world's largest exchange-traded fund, and it's also the oldest. And SPY touches the most relevant corners of the U.S. equity markets, eliminates the burden of selecting individual stocks, and does so for a fair price of 0.09% per year, or $9.45 on a $10,000 investment. And the bottom line here from Todd, last year marked the 9th consecutive year in which the majority of actively managed large cap funds, 64%, all failed to top the S&P 500. So last year, 64% of managed funds failed to beat the S&P 500. And looking even further down the road, for the past 15 years, nearly 92% of active large cap managers couldn't beat the S&P 500. In other words, the SPY is just fine and practical for a broad swath of investors. Now, 92% of active large cap managers, I don't think that would represent all ETFs, because he's just doing large cap funds there. So a little play in those numbers, but the bottom line is that it has always been the challenge to beat the S&P 500. The SPY represents the S&P 500. So if you don't know anything about the stock market, but you know that you're interested in investing, the S&P 500 / the SPY is an affordable way to jump in without really having to even know anything, basically. All right, this slide here is a little bit of an eye chart, but it goes over some of the holdings so we can get a better feel of what percentage of the SPY is made up of what companies. Off to your left here is the top holdings, and you see Microsoft at the top at 5.71%, followed by Apple, Amazon, Facebook, Johnson & Johnson, Berkshire, Alphabet, Procter & Gamble, and Visa. That's a really great core at the top percentages of this fund, and it is certainly, those stocks could carry profits for quite some time, and I think you could make an argument about owning every single one of those stocks on the board. Where I start to look at the SPY a little bit differently, though, is going to be on the right-hand side of the chart, and that's going to be like where the S&P 500 really starts to take away from my investment strategies, because it puts in some companies that, frankly, I'm just not really interested in. And while I do believe in the power of an ETF and a so-called index fund to manage risk, I want to look for better plays that take out some of the companies that I just, either I don't believe in their industries or I'm just not too interested in their growth prospects for the future. So on the right hand side here, I just picked out a few very quickly off the spreadsheet that I typically would not invest in. Mostly banks, mostly healthcare, but going down the list very quickly, JP Morgan Chase, United Health Group, Merck, Pfizer, Exxon, Bank of America, Chevron, Philip Morris, AbbVie, NextEra Energy, Oracle, Wells Fargo, American Tower, Nike, Accenture, Union Pacific, IBM, and Texas Instruments. Now, don't get me wrong, every single one of those companies makes billions of dollars, so it's not that they're necessarily horrible companies, but there's a few in there I wouldn't touch with the 10-foot pole, and that is mostly because I either think that their business model is dying, their business model, if it's not dying, its growth is so minuscule that I'm just don't really see a bright future for it. And there's still others that, while they look like good investments on paper, they don't really line up with some of the core technology plays and consumer plays that I typically get into. So my argument going forward with the SPY and into the next slides is that, hey, the SPY is okay. If you want to invest in the top 500 companies in the stock market S&P index, then it's a great choice. And yes, conceivably, you could just buy this ETF on an app or something every time you got a paycheck, and you'd probably do pretty good in the long term, right? So this is a type of investing strategy that, you know, Warren Buffett and other big name people always recommend to small-time investors. I just want to massage the view just a little bit and show you how, at least in my opinion, you can avoid some of the dogs on the S&P 500 and significantly outperform the performance of the S&P without inheriting a ton of risk. All right, so the first SPY alternative I'll throw up here on the board is the QQQ, Invesco QQQ Trust. This basically represents the top 100 companies in the NASDAQ today. So the NASDAQ, if you're not familiar, it's sort of a heavy tech growth orientated stock exchange. And this particular fund that tracks the top 100 companies has done very well over the past several years. And because it's market cap weighted, that top 100 fluctuates in and out a little bit. So as people really stumble, you'll see those folks drop out of the QQQ because at the end of the day, there's only room for the top 100. And that makes a substantial difference in your returns. Looking at the QQQ, you got a price today of $198.87. Obviously, this is posted in April of 2020, so we're dealing with the health scare right now. It does have a dividend yield of 0.85%. One thing that's important that I did not cover with the SPY is it has a dividend yield over 2%. I want to say 2.25%, but just know that it's over 2. So with Invesco, you're going from a 2+% yield that you would get with the SPY. Invesco drops to less than 1%, right? 0.85%. So on paper, that's a loss. Also on the expense ratio, the SPY, as we saw, comes in at, call it 0.1% when you round it up. So roughly $10 for every $10,000 invested. Invesco is a 0.2% expense ratio. So instead of paying $10 every year for every $10,000 you have invested, it will cost you a whopping $20 for every $10,000 invested. So you do pay slightly more, and depending on your level of investment, that number could be basically Zippo if you're outperforming to a high degree. All right, first chart here that compares the SPY to the QQQ is a 1-year chart. So looking back in recent history, how has the SPY performed against the QQQ? The SPY here is in purple and the QQQ is in blue, and over the past 12 months, QQQ has returned a 6.4% return, while the SPY is down -6%. I wanted to highlight where the health crisis has sort of hit us here in February into April, and you can see that despite the changing economic factors and despite the changing environment of investing as a whole, the QQQ has still maintained a decent lead over the SPY. Now, 1-year performance is great. However, most of us are going to be invested much longer than that. So for this next slide, I'm going to pull up a 13-year variation so that we could factor in the mortgage crisis of 2008 as well as the health scare that we have going on here today. And if you go back to 2008, and the SPY is in purple, QQQ is in blue once again, and you look at the charts, even in 2008 and riding out into 2009, the QQQ did maintain an advantage over the SPY during that financial crisis. And of course, it's 13 years and it's compounding gains, so you can see the difference of how performance has been, which is pretty significant. And by the time you land on 2020, you have a stock appreciation of 332% for the QQQ, and you have 82% gain for the SPY. Now, one thing that you're not going to have represented in these charts is the dividend payouts and if you reinvested it. I cannot find a good calculator to incorporate dividend reinvestments. So if anyone has one, by the way, leave it in the comments. But we know that you're losing a little over 1% from the dividend difference, and you're paying slightly higher expense fees, which honestly, I'm not even going to bother with that because it's a difference of $10 for every $10,000. So basically, if you had $100,000 invested in each of these 13 years, you would pay the difference of $200 versus $100. It's really not even worth calculating, especially since your returns would be so awesome at that point. But the dividend part would affect this return. It would not, however, in any way, shape, or form, push the SPY over the QQQ. So, you can add 1% every year compounding through this stretch. You are going to see a slight difference in the win-loss ratio, but at the end of the day, QQQ up 332%, versus the SPY at 82%. This to me exemplifies the strategy of investing in the top 100, particularly the top 100 of a NASDAQ growth tech orientated exchange versus taking the top 500, which is a ton of stocks, guys. 500 is a ton of stocks. And so inevitably, you're going to have some real downers in there. Okay, the second ETF I would recommend over the SPY is the IYC Consumer Services ETF. There's more than one consumer services type ETF out there. I personally hold the IYC, so I chose this one because I'm super familiar with it. There are alternatives to it that may be better suited for you, but the bottom line, what we're comparing here is basically the crux of America, okay, and that is consumer spending. Consumer spending drives American industries, it drives American economy, and 9 times out of 10, if the consumer is doing well and spending well, then you're going to see significant returns in the stock market, all right? The times that that doesn't happen, which we could be looking at right now, certainly in the short term with the health crisis, consumer spending is way down, right? So stocks are way down, and that's not a big surprise. I think all of us investors are hoping that we bounce back quickly, and that is maybe the short light at the end of the tunnel in this particular crisis, is there is an opportunity to beat this virus, which would almost immediately send the economy back in order. It will take time to get back to par, so to speak, but we obviously have a quick opportunity to get back there. Looking at the IYC as a whole, you got a stock price of $186 today. The yield is 1.24%. So again, the SPY in the neighborhood of 2.25%. So the SPY gives you an advantage of an additional percentage point there. On the expense ratio, the IYC is roughly 4 times more expensive, and that works out to be, on these expense ratios, if you look at them in $10,000 investing increments for the IYC, you would pay roughly $42 per year on a $10,000 investment. Again, though, these expenses, I don't want to spend a ton of time on them because they really are small for all of these ETFs. And you can nickel and dime them and work them into calculations. It's almost not even worth it. You're talking about $42 across $10,000. You know, if you're a self-investor like I am and a lot of people on this channel, you know, you go to any sort of financial professional and you can start throwing 2, 3, 4% out the window as soon as you start buying their products and assigning their services. So don't get too hung up with the 4 times expense ratio of IYC. All right, similar that we did with QQQ, let's take a look at the SPY versus the IYC in a 1-year context. All right, so we have the SPY is in purple, IYC in blue. All right, in the first 9 or 10 months of this period, you know, consumer spending was pretty strong. You did have the IYC leading the race, so to speak, through about October, and then there was a flip and the SPY took off slightly over the IYC. And then when it came to the health crisis, no surprise, the IYC, which is involved in consumer spending, it did fall, right? It fell more than the SPY. However, it was interesting to me how quickly, or how closely I should say, and at the end of the 12-month stretch, you have the SPY ending at -6% and you have the IYC ending at 11.42%. So on a short-term basis, in this 1 year, IYC actually lost more money than the SPY. They both lost, but obviously in the midst of the health crisis and the period of time that we're looking at, which is basically April through April, there was definitely going to be some lop-off there at the end of the period. Let's take a look at the longer-term chart. All right, so this is the 13-year chart, similar to what we did with QQQ. Tried to work in the financial crisis of 2008, and while it's hard to see with all these dividend indicators, the SPY, which is purple, IYC is blue, the SPY was winning into 2008 and the beginnings of 2009 when the dip happened. And coming out of the dip, though, the IYC really starts to separate, right, from the SPY. And it doesn't take too long for consumer spending, as we all know, in the bull market to kick into full effect. And that means consumer spending out the wazoo, basically. And you see that, you know, heading into 2019, you had a very significant gain by choosing to invest in consumer spending, consumer discretionary, as opposed to saddling yourself with 500 stocks from different sectors. Once we get to the end of the line of this 13-year stretch, you got IYC at plus 159%. You have the SPY at plus 73%. All right, so you basically doubled your money in this recent 13-year stretch of betting on consumer spending over a 500 stock assortment that touches every single industry. And the point that I'll make, and you can actually go back much farther in time before these ETFs even existed, is the reason the IYC, which is sort of an obscure ETF to feature here, but the point of this whole thing is even if you just focus on consumer spending, love it, leave it, whatever you think about consumer spending, it makes the economy here in America. It's just bottom line. It almost doesn't matter what other industries are doing and how they're faring. The IYC and consumer spending as a general sentiment is going to lead you to the wins in the stock market. Now, similar to the QQQ, we do have to incorporate in here that you lost a percentage point of dividends, at least a percentage point of dividends across the stretch. So the lead, you know, if it's 100% difference right now, let's just for the sake of argument say it's a 75% difference, which I don't even think it would be that big. However, it is something to factor in. The bottom line, though, is that we have two ETFs that I represented here that have two slightly different takes on how they address the market. NASDAQ Top 100, IYC Consumer Spending Focused, and they're relatively safe, right? Both of those, for all the safety benefits that you see in the SPY, these same safety benefits are represented in these ETFs. Now, they are a little more consolidated. There's not 500 stocks in each of them, but they're still market cap weighted and focused on the top performers. And in my personal opinion, if you're tracking the NASDAQ Top 100 and you're tracking consumer spending in America, those are your two best bets to make a lot of money in investing over the long term. All right, so that's my case, but I'm going to finish with a couple points here for you to think about as you're investing in index funds. Doesn't really matter if you like the QQQ or you like the IYC. These points are valid for just about any type of index fund investing that you can think of. And the first one is, how strong are your winners? What you're going to find in any fund across the board is that your top 10-ish% of winners in that fund are going to carry the fund. So if you don't like the first 10 to 15 names that are represented on your fund's list, then you should probably not invest in it, okay? Because that's going to represent where all the growth comes from. And of course, to follow that, you have to focus on the losers. Who are the losers? Do you think they're going to keep losing? And how much of a portion of the current percentage are these losers in? There's no reason in today's market to invest in things you don't believe in. There's simply too many options out there. You don't need to go to a world stock market fund or an S&P stock market fund to find the companies you like. there is 1,000,001 ways that you can focus on the ones that you think will perform without being saddled down by the companies you've never heard of or you have no idea what they do. The bottom 50% of most traditional index funds are not the greatest investments. So you as an investor have to look through that list, figure out what the risk of carrying these guys to the finish line is, and do you just want to lop them off and choose a different investing strategy, or just find a new fund that doesn't have these losers in it. All right, point number 3 is kind of simple, but I know there'll be a lot of comments about the SPY is great, 50 years, it's always the best, whatever the story is there. Look, SPY isn't bad. It has a track record of success, which is more than we can say for a lot of people in the investing community. My point here is, if you do have SPY or you feel like SPY gives you a risk advantage, then by all means assign a percentage of SPY purchases to your portfolio or the global stock market index. The real key though is, let's say you put 25% in the SPY. Get out of the SPY world from there. Leave your 25% or keep investing on that pace for 25%. But then that's your safety net, right? That's why you're investing in the SPY, because you have these 500 companies, you have low risk. So your safety net is there, it's signed up, it's done. Now you need to go out and find quality companies that may have more risk, or quality ETFs that may have on paper more risk, but they can provide you the returns you need to really make your money move. And finally, guys, just remember, 1 or 2 index funds is not an investing portfolio. Even if you only invested in SPY, let's say for the past 13 years, and you were up whatever it was, 75%, well, I would shake your hand after that 13 years and congratulate you on a plus 75% win. In the back of my mind, I'd be thinking of how much opportunity you lost out on by just being pigeonholed into one investment, 1 or 2 investments. You have to spread your wings a little bit, talk to a financial advisor, research every day, watch stock market news as much as you can, get a feel for what's trending. It's pretty easy right now because it's almost all technology, consumer-orientated stocks. And if you only did SPY before you die, so to speak, you will likely win. You will likely come out with a win. But you will have missed opportunity, even if that opportunity is plus 20% more, plus 30% more. It's a pretty significant change depending on what you're saving up for. If you had plus 30% budget for your rent and retirement, that could significantly upgrade where you're living, right? Plus 30% for the vehicle you drive in retirement or in and around there, that gets you a nicer vehicle for sure. So those are the things to think about with this video. It's not so much that the QQQ and the IYC are the greatest things of all time, but when you stack up your performance across those stretches, you start to see, hey, maybe there's more ways to invest than just the SPY, and that's what I want to get most people thinking about. Hope you guys enjoyed this video. Please give me a like and subscribe if you enjoy stock market content like this. I'll see you on the next video.